we will move on with oil being such a big story at the moment. And of course, lingering themes with the coronavirus. Let's bring in James Gerrish from Shaw and Partners for his take on a bit of a local follow through. James, pleasure to have you on the program this morning. Now, I know you were saying to us, perhaps what we were hearing from Ed Moyer, this oil story, perhaps not as a big deal for markets as is being made out. But of course, it is historical nonetheless to see a 300% fall in that May contract.
Yeah, good morning to you, Ingrid. Absolutely a historical night in the oil space. So I'm not taking that away by any stretch of the imagination. I guess the view is around what it means for oil going forward. If you look out longer in the curve, then the further out in the curve was a lot flatter. There wasn't the huge amount of volatility we saw in the front month. So obviously storage is an issue. Obviously there's a lot of speculation in the oil market at the moment. So we saw panic selling. If you don't want to take delivery of a barrel of oil, you've got to sell it at any price, and that's what we saw in the market overnight. So that's why futures, front month futures, dropped the way they did. You think about the oil ETFs. Oil ETFs have to roll futures contracts. That's what they're exposed to. There's a lot of money in ETFs at the moment. There's a lot of speculation in the energy market. So I think that's the catalyst or what caused the overnight moves.
BHP, James, no doubt you're keeping an eye on this one. Most people who trade the Australian market are. It's come out with its numbers, production numbers. I guess key to this is it's saying it's reviewing FY 2021 capex guidance, expected to lower it by about from around $8 billion US, which is where it was sitting. Also talking about copper guidance under review for 2020. No surprises, though, to see a lot of these things under review. I mean, pretty much every business has to be under review in terms of their strategic direction going forward. But what did you take out of these numbers this morning?
Yeah, absolutely. It's the environment we live in. So it's a very fluid environment. They made mention of coronavirus a number of times and the impact that could have on demand for some of their resources. So the main one being iron ore. So for the quarter, they produced 68.4 million tonnes of iron ore. That was slightly ahead of expectations of 67.6. They also reconfirmed full year guidance in terms of the iron ore production, which that full year guidance was 242 million to 253 million tonnes for FY20. So for full year 20, I should say. So that's good in terms of the iron ore output. Not surprising they're looking at pulling back some of their capital expenditure. They also made mention of any uncommitted or non-committed spend in the energy space over in the US. Obviously, that's going to be pulled back. So just tying that back into the oil price overnight, that's what's traditionally, well, that is what is likely to happen. So these energy companies will start to pull production. Energy companies will go to the wall. And there's nothing that sort of solves low energy prices than low prices themselves. So production will eventually come back online. I know, from the short term, it's painful in the energy space. There's no two ways about that. But over time, production comes back online. Production gets pulled off, I should say. Non-economical production gets pulled off. And that's what underpins prices medium term. So if you look out further on the curve, June contract still trading I think mid-20s, and then September's about $30 a barrel. So not as dire as what the front month contract suggests, Ingrid.
Okay, so in terms of how you expect BHP to trade today, I mean, there's a lot of factors. It's a hard question to ask you because, of course, there's so many factors playing into BHP, not just these production numbers, but, net, how does it sit, do you think?
Yeah, I think the commodity space looks all right. It's actually handled the current volatility pretty well. So you often see a flight to quality in these sort of environments. So those companies that have got strong balance sheets, diversified production bases, etc. So in my mind, BHP is sort of a company that you naturally gravitate to in periods of market volatility like we're seeing at the moment. The mining space in Australia is held up pretty well because they've had solid balance sheets. They've gone into this crisis. The majority of them have got net cash on their balance sheets. Those that don't, which are the majors, have a really clear pathway to retire debt. They could retire debt if they wanted to. So look, I think we've gone into this crisis, unlike sort of the GFC, etc., where balance sheets were sort of stretched. Resource companies, particularly in Australia, have been really reserved in making acquisitions, really reserved in spending money, putting money into the ground, etc. So that's put them in pretty good shape leading into this crisis. So BHP to me looks a natural place if you want to invest in the resource space at the moment for a recovery in global growth, which will play out at some point.
Can I ask you about Virgin? Not a lot of news yet, though a heck of a lot of speculation heading into today. Do you think, I think tomorrow's the cutoff from when we have to hear from Virgin, but no doubt we'll hear from them this morning before the open. Is that what you're expecting? And if all speculation is correct and they do go into voluntary administration, what does this mean?
Yeah, I'd expect an announcement before market today. They will likely appoint voluntary administrators. I don't think this is the end of Virgin. I think this will be the catalyst to restructure Virgin going forward. Of course, they've got a huge amount of overseas ownership. They've got some shareholders with deep pockets. They're carrying too much debt, as we all know. So this will be a process of debt holders taking a haircut, equity holders taking a bigger haircut, restructuring the company and moving forward with a Virgin that's slightly different to what it is now. If you think about the stakeholders in the argument, obviously the government wants to see a competitive aviation industry in Australia. Consumers want to see a competitive aviation industry in Australia. Even Qantas, its major competitor, they realise that they're not going to be operating in this sector alone. They're probably sitting there thinking, we know the devil you know is better than the one that you don't. So if Virgin go to the wall, then the government is incentivised to bring someone else in, which probably is a negative for Qantas. So I think all stakeholders in this argument want to see Virgin come out the other side. They just need to force bondholders and debt holders, other debt holders, etc., and some of their large equity holders take a haircut and put it on a more sustainable footing. So this has got a lot longer to play out.
Do you think it will stay listed?
That's a hard one. I doubt that it will stay listed. So I think it'll come off the boards. You've got to remember that Virgin was in trouble before all of the coronavirus situation has happened. Obviously, it's a real impost for the business. You lose all your revenue, etc. But it was in trouble before this. So I think the government's doing the right thing in this instance, not bailing them out in the first instance. You hold back. I've got little doubt that there will be some assistance down the track. But right now, why would the government go in there and spend taxpayer money on bailing out Virgin, which is dominated by foreign ownership?
Yeah.
It totally hold fire is what the government's doing.
Yeah, and there's been some comments from Matthias Cormann overnight, or actually this morning on Sunrise, discussing that and sort of saying, look, let the private, let them sort it out first, and then we'll kind of take another look. But moving on from that, I guess, when it comes to the airline space, what do you think it means for Qantas? That's the question here, if Virgin is to collapse.
It'll be an opportunity for Qantas. So whatever Virgin comes out of this turmoil in, they'll probably be doing less routes. They'll probably be a smaller operation, competing less aggressively against Qantas. Qantas is obviously they've got a pretty good balance sheet. They shored up their liquidity position pretty early on in the piece. So Qantas is going to get to the other side of this. I don't think they want to see government support in the industry because they're obviously the strongest operator there. So I think it's going to be a positive for Qantas, sort of no matter what comes out of this. So I think the worst scenario that could play out for Qantas was that Virgin did go to the wall. And then a new aggressive entrant with strong government subsidies, etc., incentivised by the government to come in and compete aggressively in Australia. That would be the negative for Qantas. But I don't think that's probably the base case at the moment. So, but overall, a positive for Qantas, notwithstanding the challenges they've got over the next 12 months. I think airlines, travel companies, etc., they're going to be the ones that are still exposed to this in sort of 6 to 12 months' time, whereas a lot of the other parts of the economy will probably bounce back stronger and quicker once the lockdown finishes.
All right, James, always a pleasure. Lots to watch before the open. We'll let you get back to it. Thank you.
Thanks, Ingrid.